Ladies and gentlemen, good day and welcome to Baazar Style Retail Limited Q3 and 9-month FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Samant from Stellar IR Advisors. Thank you, and over to you, sir.
Good evening, everyone, and thank you for joining us today. I have with us today the senior management team of Baazar Style Retail Limited, Mr. Shreyansh Surana, Managing Director, and Mr. Nitin Singhania, Chief Financial Officer, who will represent Baazar Style Retail Limited on the call. The management will be sharing operating and financial highlights for the quarter and 9 months ended December 31, 2024, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon the company beliefs, opinions and expectations as of today. These statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Shreyansh Surana. Thank you, and over to you, sir.
Good evening, everyone. Welcome to our Q3 and 9 months FY25 earnings calls. Our presentation has been uploaded on the exchange and the company's website, and I hope you had a chance to go through it. I am happy to report a revenue growth of 24% year-on-year to rupees 4,116 million in Q3 FY25 and 33% year-on-year to rupees 9,983 million in 9 months FY25. The SSG saw a growth of 10% in 9 months FY25. However, we have registered a degrowth of -3% in Q3 FY25. The reason behind this muted SSG growth in Q3 FY25 was that in the previous quarter, that was Q2 FY25, we saw a boost in growth due to a favorable festival demand, particularly driven by the earlier timing of Durga Puja this year, which was advanced by 11 days. This factor contributed to our Q2 performance. As a result, Q3 FY25 appears subdued in comparison to the same period last year, which also had the benefit of festival-driven demand. As a significant portion of our L2S stores are located in the states of West Bengal, Assam and Tripura, where sales are heavily influenced by the Durga Puja season, the SSG in this region was impacted for Q3. However, for the 9-month period ended December 31st, 2024, this state showed positive growth. In contrast, our stores in other regions performed strongly with the positive SSG growth in both Q3 FY25 and 9-month period ended. It is important to note that the local festival can cause some fluctuations in performance on a quarterly basis, but we remain confident in our overall growth trajectory. Despite this short-term variation, our performance on a yearly basis is aligned with our guidance and strategic plans. Coming to the financials, I want to start by talking about the quarter gone by. So in Q3 FY25, we saw a healthy top-line growth of 24% year-on-year and 32% quarter-on-quarter to rupees 4,116 million. Our gross profit increased by 25% year-on-year and by 69% quarter-on-quarter to rupees 1,553 million. Our EBITDA was up 10% year-on-year and 242% quarter-on-quarter to rupees 833 million. And our reported profit after tax was at rupees 304 million. Coming to the 9-month performance, we witnessed a robust growth of 33% in the top line to rupees 9,983 million. Our gross profit grew by 34% year-on-year to rupees 3,381 million, and EBITDA grew by 26% year-on-year to rupees 1,497 million. The profit after tax stood at rupees 211 million. As you know, we report our performance in accordance with the Indian accounting standard due to regulatory requirement. However, Pre-Ind AS provides a clearer and more accurate representation of our expenses. We recommend assessing our financial performance on a 9-month basis or a trailing 12-month basis rather than quarterly basis, as our regional nature may cause volatility in quarterly results primarily due to the significant influence of festive timing. We are currently in an accelerated growth phase with a strong focus on expanding our store footprint As you know, we have opened 43 new stores in 9 months of this financial year. It's important to highlight that new store takes time to reach their full potential, which can impact our operating margins. In the first year, we typically expect new stores to generate around 5% operating margins. In the second year, 8 to 10%, and by the third year, it's 14 to 16% at pre-Ind AS levels. That said, our new stores have been performing better than expected at the operating level this year. However, at the entity levels, the corporate overheads have increased by 0.85% from last year, majorly due to the capacity expansion of warehouse, office expansion, and increased manpower in the field of procurement, supply chain, operation, and technology, considering the future growth. These costs are expected to be better absorbed as we scale and drive higher revenue going forward. In addition, our portfolio of mature stores continues to grow. We anticipate stronger operating leverage, which should lead to improved margin expansion. Internally, we have set an absolute number target for EBITDA, and I am pleased to report that we are on track to meet those goals as we move forward. I would like to highlight our pre-Ind AS financials. Our EBITDA for 9 months FY25 stood at rupees 827 million, up by 23% year-on-year. We are on track to close the financial year with an EBITDA of around rupees 950 to 980 million. We continue to remain a growth-oriented company while focusing on sustainable and healthy EBITDA growth. Coming to the operational performance, in Q3 FY25, the total number of bills stood at 4.26 million, taking the 9-month FY25 total to 10.67 million, which is up by 39% year-on-year in 9-month FY25. In Q3 FY25, the total quantity sold stood at 13.04 million, taking the total to 35.29 million, up 36% year-on-year in 9-month FY25. In Q3 FY25, the same-store sale growth stood at -3% and 10% in 9-month FY25 versus 5% in 9-month FY24. In Q3 FY25, the ATV stood at 1,031 and 998 in 9-month FY25. In Q3 FY25, sale per square feet stood at 826 and rupees 737 per month, up 9% in 9-month FY25 year-on-year. Private label contribution was at 38% in Q3 FY25 versus 35% in Q3 FY24 and 44% in 9-month FY25 versus 37% in 9-month FY24. Our inventory per square feet has reduced by 200 rupees square feet from last year. The demand landscape remains strong and we are optimistic about upcoming quarter. With the wedding season and the Eid approaching, we expect a strong performance in Q4 FY25. Our commitment to our growth strategy continues to deliver results with a net addition of 37 new stores in the first 9 months of FY25. We have opened 18 new stores and closed 3 stores during Q3 FY25. As of December 31st, 2024, we operate a total of 199 stores with a total area of 17.89 lakh square feet. With this expansion, we are on track to exceed our original guidance of 35 net stores addition for FY25. We now expect to add between 45 to 50 stores by the end of this fiscal year, further strengthening our footprint and positioning us for continued growth. In the light of 33% year-on-year top-line growth reported for the first 9 months of FY25, we are revising our full-year guidance to 30% growth from 25% for FY25. As mentioned previously, consumers are increasingly moving towards organized channel. This trend is proving to be a key tailwind for our business as consumer preference continues to evolve with a stronger focus on brand consciousness at affordable pricing. We aim to expand store count further through deeper penetration in core market and forming new clusters in focus market. We are confident that our strategy will continue to drive long-term value and we look forward to delivering strong results in the upcoming quarters. With this, I request the moderator to open the call for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Gaurav Jogani from JM Financial. Please go ahead.
Thank you for taking my question. Shant, my first question, is with regards to the profitability performance on the pre-Ind AS side, especially even for Q3. So, if we look at, despite the strong top line growth, on a Q3 basis, still we are, not grown much on the profitability side, on PBT front also, on a pre-Ind AS. So what would you allude this to? How will we overcome, so despite driving the top line growth, that is not translating to the profitability growth?
So thank you for the question. So in that way, because as I already mentioned that there was a preponement of 11 days of Durga Puja. So effectively, the first half became much stronger. So if you see over the first 6% performance against 11 crores pre-Ind AS EBITDA, we registered a EBITDA of around 26 crores. So the major profitability of October shifted to September this year. That is the reason that Q3 numbers are subdued because of the shift of Puja by 11 days.
Yes, but so even if we consider Q2, Q3 together, I mean Q2 I think we registered a PAT loss, if I'm not wrong, on a pre-Ind AS basis, and Q3 also the profitability was down the PAT basis on a YOY basis. So even considering the Q2, Q3 performance together, don't you think the profitability could have been even better versus what you have seen right now?
So at the store level, we are doing better in profitability. If you see at a 9 month, as I said, you have to see for the full 9 months. So at the store level, we are doing much better. So our performance has been improved in the store level. Basically, the major reason is the increase in cost side on the corporate overheads, which has increased by around 0.85%, as I mentioned during the commentary. And that is majorly because of the expansion that we are doing, and because of that we are doubling the capacity at warehouse. So last year the warehouse size was around 86,000, which we have doubled this year. We have increased our office space, we are increasing the manpower, so that we can sustain the future growth. At the store level, last year it was 14.08, which is 14.22. In spite opening 46 stores, which have also resulted in increase in expenses, still at the store level pre-Ind AS EBITDA is higher than last year by 15 basis points.
So, Sheth, if you can give us this metric, what would be your X of the corporate overheads? What would be your store level profitability on a company-wide basis?
So for the first 9 months, it is around 14.23% against 14.08% last year 9 months for the full 9 months.
Okay, and so this, sorry, you're saying something?
Including new stores.
So the absolute, if I consider the absolute profitability, I mean, in that sense, and if you can give the absolute corporate overheads number, that would help us to better appreciate the cost increase. Because then what will happen is as you increase the store count, etc., and hopefully these corporate overheads will not increase in the same pace, and that could translate to better profitability.
So approximately 60 crores, around 60 to 65 crores has been the corporate overheads for the first 9 months, against which last year it was around 40 to 45 crores.
Okay, so there's approximately 20 crores out of 20 to 50 to 20 crores, I would say, incrementally or because of the corporate overhead, right?
Correct.
Okay. And since the second question, is with regards to the choice between, growing aggressively in terms of store expansion versus profitability. What would you, prefer in terms of the strategy? Would you still, continue this aggressive store of expansion, or would you, would focus now on stabilizing the existing stores, taking them ahead, and focusing on profitability? What would be a choice as a strategy as a company you would like to follow?
So, I believe in this, today as we are growing, we are seeing a good amount of profitability is that we are able to create at store level. So till the time we are able to create profitability at store level, I think we can go with the growth strategy that we have done. And as a company, we have a very balanced approach in terms of growth strategy. We would like to grow ourselves between 25 to 30% in terms of revenue, with an L2L growth around 8 to 10%. I think which is a very balanced strategy, and it's more sustainable and profitable from the organizational perspective.
Sure. And lastly, if you can help us, give us some balance sheet side numbers. I mean, if you can help us, what is the working capital days or the inventory days right now at the end of Q3, and what would be the cash balance or the net debt levels that you would have?
In terms of inventory, we have reduced our inventory by 200 rupees square feet from last year. So we were at 2,300 rupees square feet inventory, 9-month FY24, which is around 2,100 rupees of square feet as on 9-month FY24.
Sure. And the balance in terms of cash or net debt?
So, net debt is 100 CR, bank borrowings is 100 CR, and bill acceptance is 16 CR. Total debt in books is 116 CR, and cash and bank balance is 14.63.
So there is a gross net debt, I would say, is around 100 crores, right?
Yeah.
Right.
Okay. And but post the fundraise, we had paid off the debt largely. So this incremental debt that you would allude to would largely be for store expansions, or what would it be related to?
So it's a mix of everything because we have reduced the debt once we receive the fund from IPO. So majorly the store expansion, and along with that the insurance payment that is still to be received. So largely on that account also this debt has been increased.
Okay. So I'm assuming you see 43 stores and approximately 2 crore per store, including the working capital requirement that you would have, would mean 85-86 crores out of this number. But given that your inventory has gone down, wouldn't that should help some release, and therefore the cash balance should have been better? Or we are just considering the 43 odd stores, but there is also some capex gone towards the future stores plus the warehouse expense also?
Yeah, so basically there has been a capex involved in the warehouse also, and you rightly said there are a lot of stores which are in line up for this quarter also. So mix of both. Majorly on account of the payment, as I said, the insurance payment is still we have not received as of now. So that has also created a little bit of higher bank limit utilization.
Okay, Shyam. Thank you, and that's all.
Thank you.
Thank you. Next question is from the line of Devesh Advani from Reliance General Insurance. Please proceed.
Am I audible?
Yeah, you're audible.
Sir, there is a degrowth in SSG in this quarter of 3%. So what has led to that degrowth? And one more thing is that there is a PAT decline. So as far as I can see, there is an other income which has declined. So what is there in other income? What are the contents there in other income that has declined?
So in terms of SSG, as I said now, because we are highly concentrated in Assam and Bengal, it has led to a -3% dip. If I have to break West Bengal, Assam, Tripura and other rest of the states, so rest of the states saw a healthy SSG growth of around 7.25% for this quarter.
Okay.
So it was majorly on the account of West Bengal, Assam, Tripura that the Q3 SSG was at dip. On the year or for the full 9 months, if you see, so Bengal, Assam, Tripura stood at 10.72% in terms of SSG, and rest of states stood at 9.83% for the 9 months. So put together, it's 10.4%.
Okay. And as far as profitability is concerned, what has led to decline in other income?
So, if you see other income, last year in the December quarter, we have purchased 3 stores. So approximately 5 crore was the profit on modification of lease because of the ROU reversal as per Ind AS 116. So that has led to a decline in the other income this year.
That is why we are saying the pre-Ind AS numbers represent better expenses and numbers in terms of understanding the retail.
So sir, what is the guidance as far as profits are concerned that you will maintain going further?
So if you see, we have already reached 84 crores of EBITDA including other income, and for this year, I think in terms of pre-Ind AS EBITDA, we would be at around 95 to 98 crores, as I already mentioned. And on the guidance on the EBITDA margin will be between 7 to 8%, and on the PAT side it will be between 3.5 to 4%. 3 to 4%, sorry, 3 to 4%. Yeah.
So this is for FY25 or for 26?
FY25.
Anything for FY26?
I think, see, in terms of number, I cannot comment on the future numbers, but you can expect that every year we are increasing. So at the end, our target is to reach around 5% as a PAT margin. I have told in earlier calls also. So that is the target that we would like to reach in next couple of years. Means in at least in next 5 to 6 quarters.
So sir, as far as your sales mix is concerned, the apparel is taking a shift. That means they are rising and general merchandise is declining. And how about private labels? So what is the margin combination that you get as far as private labels and apparel is concerned?
So in terms of private label, this year we have done a sale of around 44% from private labels, against which 33%, against which 0.5% has been the higher margin that we are earning on private label. But as a strategy, because we want to expand our footprints in all the areas and expand our private label brands in all the areas, as a strategy, we are going for an aggressive pricing. That is why we are not increasing margin at a very high bips in the private label category, so that we can increase the market share of private label. Maybe in near future, we can increase the margins also.
Mm-hmm. And how about apparel and general merchandise?
So in terms of apparel, our 87% of our revenue this year has come from apparel and 13% from general merchandise.
Right. So what are the margins in these categories?
On an average, approximately, we can say that the margins will be on the similar line. General merchandise category has a lower margin of around 30 to 31%, whereas apparel carry a higher margins.
Okay. All right. Thank you.
Thank you. Next question is from the line of Pranav Shrimal from Pink Wealth Advisors. Please go ahead.
Hello.
Mr. Pranav, please go ahead with your question. You are audible.
Yeah, thank you for the opportunity and congrats on the sort of numbers. I just had a couple of questions. Can I know the mature store SSG and the new store SSG?
So basically, the SSG stores are only mature stores. The stores which are older than 18 months comes under the SSG category and comes as a mature store. So the 10.4% 9 months SSG is for those mature stores, which is currently around 133 stores are in this category out of 199.
Okay. So the new stores are not included in this number?
No, in the SSG number, because they don't have any base of last year, na?
Got it, sir. And the sales that we do are in apparel and merchandising, can I know what percentage of the sales would be full price sales?
Can you just come again? I'm not able to hear the last words.
Yeah, can I know the percentage of full price sales that we have done?
90% is the full price sale through.
For the first 9 months.
For the first this year.
For the first 9 months, yes. Hello?
Hello?
Yes, sir.
It is 90% in the first 9 months for this year.
90% at a gross level, correct?
Yeah, the full price sales.
Got it. And what will be your inventory turnover, sir?
So inventory as on date is 112 days.
112 days. Got it, sir. And just one question. Our net debt, as you said, stands at around 100 crore.
Yes.
So for the expansion, have we taken up any more debt? Because our interest payment has been pretty consistent quarter on quarter.
No, so we have not taken any debt on that part as of now. For this, as I said, there was a fire incident in the Q1, against which we are awaiting the payment coming from the insurance company. As a result, the larger part of the debt is used on the payment which we have already done to the vendors, which were affected during the fire time in the Q1. So around 48 crore is the expectation amount from the insurance company, which is due as of now. So that fund is also utilized in this limit.
So to add on to Sean's point, this year the interest cost is 1.06% vis-a-vis 1.23 last year. And secondly, if you see quarter on quarter, this year in Q2 it was 4.43, which has reduced to 1.6 crore. So there is an average costing of 55 lakhs per month for this quarter vis-a-vis 1.25 last quarter. So our interest cost is on declining phase.
Thus, it will decline further once we receive the insurance payment also.
Okay, that will be used to prepay the borrowings, correct? And one last question, sir. In the coming time, where do you see the major growth coming from? From which state are we seeing the growth coming from?
See, as a strategy, as I said, in terms of growth, we are seeing a growth in SSG in both the core states and the focus states that I have mentioned you. But as a strategy, we are opening 70% stores in the core geography, which is a strong fort for us, and 30% we are opening in the focus territories. So majorly in focus, we are focusing more on UP as a state, and in the core Bengal, Assam and Odisha.
Got it, sir. That's it from my side. I will join with you. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participants. If you have any follow-up questions, please rejoin the queue. Next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is around warehouse capex. So, say if you had 1 lakh square foot of store area, what kind of warehouse would you be adding for that?
It is 1 lakh. Can you come again with your question? I didn't get your question actually.
So I just wanted to know after how many stores do you need to add a new warehouse, or the ratio of area of stores to warehouse?
On average, we consider the 15% to 20% of the rental area should be the warehouse area.
Okay. And sir, what would be your head office cost as a percent of total employee cost? And if I look at total operating cost, what percent of that would be fixed and what percent would be variable?
In terms of HO cost, for the first time last year, it was around 5.08, which is increased to 5.93. As I've already mentioned, it has increased because majorly the spending has been done on the expansion side, on warehouse, office space, and the manpower that we have hired for all the divisions. In terms of fixed cost, I think rentals are majorly a fixed cost, and employee cost, you can say it's a fixed cost. So these 2 costs are generally fixed, and all other costs are variable.
Okay. Yeah, sir, that's it from my side. I'll come back in the queue.
Thank you.
Thank you. Next question is from the line of Tanmay from BOI Mutual Fund. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Sir, wanted to understand the reason behind decline in GM&A mix over the quarters on a YOY basis and even in sequential basis.
I think GM mix on an average for last few years have been between this 13 to 15% sweet spot. So generally, whenever for this year, for example, this year we believe the trend is showing that we can address more stock on the April side. So we filled the store with more inventory on the April side because of the better margins. As a result, the percentage of sale mix is 87 and 13, which was 84 and 16 last year. So it's a gap of 2 to 3%, which is always for the last few years. It ranges between that range only.
But sir, do you think when we keep a low SKUs of general merchandise, so maybe that could be the reason new customers might not be attracting in the store, or because a proper mix of even if 2-3% if we keep more may change the game, or how you look at this?
So GM in general merchandise always, because we tell ourselves as a family store. So the purpose of keeping the GM was that in smaller tier 2, tier 3 cities there is no organized player, particularly in this category, and we wanted to cater the entire needs of a family. And majorly GM stands on the third. Generally, it's on the third floor or the second floor, which is efficiency-wise is the lowest efficiency floor, and they are the, I will say, footfall driver for us. So though we focus more on garments, but they are like a footfall driver for us. So I don't think as a category it replaces the sale of apparels. Yeah, it's just that the September to December was a festive quarter for us, and in the festive period, people buy more garments. So as a strategy, we put a lot of effort on the garment side. As a result, we saw better sales in April. As a result, the sale mix changes from 16 to 13% on the GM side.
The transaction value of apparels and general merchandise have a major gap. Is my understanding right?
No, so there is no major gap. If I'm understanding your question, well, there is no major gap between that. General merchandise is just a footfall driver for us, in which the focus, because we always tell ourselves as a value fashion retailer. So general merchandise is just a footfall driver for us, in which we try to give a lot of things to the tier 2, tier 3 people, where they don't get this general merchandise section in the organized level. So in GM we keep cosmetics, imitation jewelry, plastic bottle, utensils, blankets, shoes, etc. And
that's
as I
my
said,
question. Like if you can help me in understanding like what is the average bill value of apparels and average bill value of general merchandise?
it's in the same range, but in terms of ASP, if you say, I think the average ASP of the company is around 310 or 305 right now. So you can say that the April is around 380 to 400, whereas general merchandise is around maybe on an average ASP level, maybe around 200 or 150 to 200 level. On an average, the average ASP becomes 302.
Okay, so general merchandise ASP is below than apparel. Okay, understood.
Correct.
Okay. And sir, second question I have is there is a continuation shift of unorganized players to organized stores. So do you see that SSSG and value fashion companies are doing well? So do you see 10 to 15% SSSG continuation for the next year also for us?
I think the healthy SSG is around 10%, which I believe that the tailwind is in the favor of us right now, all the value retailers. So I hope, and I also see that in future also we are able to grow, because what we are seeing is that right now with the internet penetration and the Gen Z coming in, the people want more comfort, and they want that AC environment, trial room facilities, which are not present in the unorganized sector. So people are moving from unorganized to the organized. They want better merchandise, better designs. So I think, we can expect a good, I will say, growth for the value fashion retailer. And secondly, even if you see all the developed nations also, so all the countries have got their value fashion retailers. Maybe it's Primark, Zara, H&M. India is the only country which doesn't have a single value fashion retailer. And because of the cultural diversities, India can accommodate many value fashion retailers that way.
So 10-15% SSG can be made in next year as well. Understood.
10% can be achieved easily.
Understood. And lastly, on the private label front, so sequentially, I've seen there is some decline from the last 3 quarters in private label contribution. So what is the factor leading to this? Or is this kind of seasonal thing?
Pardon, can you come again, sir?
Sir, my point is the private label contribution to sales is declining on a sequential basis. So is that because of seasonal factor or something else we are missing out?
No, it's on a seasonal factor only, because if you see 9 months now, it has increased from 37 to 44%.
So first and second quarter, the private label contribution remain high. Is that so?
So basically what happens is that in Q3, generally there's a shift of festival, and along with that it's a winter season. So winter season is not, in terms of the winter articles, we don't have private labels in winter that much. So it's majorly other labels, and winter has a higher share in month of November and December. As a result, for the Q3 it looks on the lower side, but for the entire 9 months it is on the higher side.
Understood, sir. Thanks a lot.
Thank you. Next question is from the line of Bhavik Narang from Western Research. Please go ahead.
Thank you, but all my questions were answered.
Thank you. Next question is from the line of Chintan Shah from JM Financial Family Office. Please go ahead.
Hi. Thank you for the opportunity. So 2 questions. So one is, even if we look at the SSSG on, say, 9-month basis, which is around 10% odd, it seems to be lower than what, other peers have reported. So just wanted to get a sense from you, is this on back of the regional presence that we have since we're more east-centric, or is the competitive intensity higher? So what could be the reasons for a lower SSSG versus peers?
So, I will just say that there are a lot of things which comes when you are talking about SSG. So in terms of peer, when you say there are only maybe one of a peer who is achieving higher SSG than 10%, and that may be on the account of their geographical presence, maybe the maturity of the store network that they have, local festival and events, inventory density, etc. So I think on an average, anything in 10% is a very good SSG. From the retail per se, in my experience of last over more than 12 years in this retail category, I see 10% is a very good SSG. And apart from that, I think, again, as I said, it totally depends on the geographical presence of the stores that they have.
Okay, understood. So next question is, suppose we do this SSSG of 10% over the next 2 to 3 years, what is the sort of potential in terms of EBITDA margins that we can reach?
So, if you achieve, I will just give an example to everyone in the call. If you are achieving 4.5% to 5% SSG for a store, technically you are able to, I think, take care of the entire cost which has increased because of the inflationary pressure, maybe on the employee cost, and anything of that gives you a higher EBITDA. So typically, in our scenario, when a store becomes mature, it gives us an EBITDA of around 14 to 16% at pre-Ind AS levels. And even in this year also, if you see on the L2L side, we have from last year 0.8% has been increased in the EBITDA level on the L2L category.
Okay, got it, understood. And just one more follow-up here is, any sort of expansion, etc., or any other corporate overheads that we plan to incur over the next 2-3 years?
I think as of now, I don't think a big plan, but there are a lot of things this year we are planning. This is a year of technology for us that we have named this coming financial year. So there will be a lot of tech play that we are going to do, in which we are working a lot on different models on the inventory side, on the ERP side. We would like to start which can help us to sustain the future growth. So we are working on that. So on investing in technology will be the one part where we will be open to the expenditure.
Okay, so any sort of number you would like to give? I mean, how much you're looking to spend?
As of now, on an every year, what we as a capex, in terms of capex, as a company, we plan around 15 to 20 crores, always on the development side, sometimes on the capex infra side, sometimes on the technology side. So this year, I think 15 to 20 crores will be going on the tech side.
Okay, got it, understood. And here's this last one question from my side. So if you look at a presence, and now we are continuing to add stores, say in the range of say 25% CAGR. So to reduce the the variability or the seasonality, you think it's more prudent to expand more in north-centric regions away from say eastern regions, so that we reduce the volatility in the financials, or you think that you'll continue to focus on it? So just wanted to understand your thought process.
So see, when we say north, in terms of north, right now our focus is on UP, and UP, Bihar and Jharkhand is our focus state. So we'll be focusing on that. But while saying that, what I see, rather all the retailers who have a major presence either in the North India or Central or East India, the Q3 plays a very important role. So if you see the Q3 numbers for all the retailers, you will see it's on a very high side. Almost 55% of the EBITDA comes from Q3 itself. So that But as a company, we are moving towards UP. So I think that will again create, I will say in terms of number, the dependency on the eastern part, maybe on the Bengal and Odisha will reduce. But while saying that, the quarter 3, September to December will always be a bigger number for the north or the central or the east states, because all the festival falls in that particular months only.
Okay, got it. Understood. And just one last question in terms of competitive intensity, is there any change? Has it increased or still the same? Any thoughts on that?
It's still the same. I think there are a few players only above 100 store category in the value fashion retail, and I think the market is big enough for everyone. As I had already said, there's a huge shift from unorganized to organized going on, and everyone is doing good. So when everyone is doing good, that's very good for the industry, what I believe. And I see that coming 2-3 years, I don't see any problem in value fashion retail industry.
Okay, got it. Understood. Thank you so much for answering my question.
Thank you.
Thank you. Next question is from the line of Naitik from NV Alpha Fund. Please proceed.
Hi, sir. Thanks for taking my question. My first question is, you mentioned in the opening remarks that this year you might end up with around 95 to, say, 100 crores of pre-Ind AS EBITDA. So does that mean we will be PAT positive for the last quarter?
Yeah, so we expect a good Q4 because of good Eid, because Eid coming in the March itself. So we expect a positive PAT in Q4. And in terms of EBITDA, our target is to reach between 95 to 98 crores of EBITDA for this financial year 25.
Right. And sir, my second question is, if you could just give us a sense on the capex that you might have spent in increasing the, the corporate office space or warehouse.
So we have
the store capex.
We have invested around 15 CR in the warehouse and approximately 40 crores in the storefronts.
So for 9 months we have spent around 65 crores, 15 and 40. The split is 15 and 40. 55 crores, sorry.
55 crores, yeah.
55.
Yeah. Got it. My next question is, sir, what sort of sales does our mature stores do, per square feet or per store, the 133 stores that are mature right now?
So as at the company level, we have 8,800 per square feet sales at annualized sale for the full year. Vis-a-vis last year, it was 8,000. And for the like-to-like and like-to-like stores, it is approximately 9,000 square feet. And it will be 7,500 to 8,000 square feet for the other stores.
Right, sir. That's it from my side. Thank you.
Thank you. Next question is from the line of Arman from Blue Sky Capital. Please go ahead.
Thanks for the opportunity. Just want to stress a bit on the explanation that in Q3 FY25 our revenue did rise, right, comparatively YOY. Although that West Bengal does contribute a major percentage of our stores or mature stores, but yet revenue did rise and comparatively profit did not rise. So that can we conclude that in Q3 comparatively new stores have contributed to the revenue because our matures of the comparatively of 133 mature stores, I guess around 45% are served in West Bengal. So that's why our mature stores did not contribute well due to the season. And that's why new stores contributed and hence our profitability reduced. Is that the first reason? Because if I say our average transaction value that being reduced Q3 comparatively YOY, that also reduced. So first question is mine that. Second, of the total stores which we plan to open, like our focus you said about UP and Bihar, and one of the retailer that you also told that performed well, that is their core area of UP and Bihar where they have similarly told a very good comparatively sales to sales growth in which we are also focusing. So what is the reason why we are lagging behind and what is the explanation for total number of stores opening in which state comparatively if you see focus market or core market?
Coming to your first question, think it's a balance of both. As you rightly said that the Q3 we opened around 18 stores, and I think and for this entire year we opened 43 stores. So as a result, the cost element was higher, which also resulted in a lower EBITDA for Q3 because of the newer stores. Coming to the second question, see, in terms of the peer comparison that we have, so I will just say that, as I said, it depends on the geographical location and the inventory density. What we see in terms of core and focus states, core is a geography where we are very strongly present, so we would continue to grow that thing. But again, while saying that, we have to build stores in focus territory also, where we see a lot of potential. Now, UP, Bihar, Jharkhand market, we see a lot of potential. So though they maybe they are growing at a higher SSG, but as I said, over my years, what I have learned, 8 to 10% is a healthy SSG. So I am focusing on my numbers. If I am able to achieve 8 to 10% SSG on an average, as I said, the rest of other states other than Bengal, Assam, Tripura, for the first time has given me a SSG of around 9.83%, which will give me a healthy EBITDA on those stores also. So I think we can also open the stores as the market is big enough for everyone.
Okay. Yeah. Thanks for that answer. Just my last question is that if I just see total number of bills waived, that also signifies that we had a good footfall, but that could not contribute more to an average transaction value because probably new stores open, so people try sometimes the small stuffs and that's our average transaction value comes down. So does that mean that after this mature stores, we are healthy seeing our EBITDA margin from here onward just improving because our mature are already stores we have opened are almost from 133 to, I guess, 200 around. So coming FY26 will see continuously healthy trajectory for the EBITDA margin?
Yeah, you can say so. Because as you rightly said that because of the newer stores and because we wanted to focus more on the increasing the number of bills and increasing the number of customers in the newer stores. So aggressive pricing and because sometimes customers start with the low pricing articles. So mix of both has led to a lower ASP. But next year, as I have already mentioned that the store life cycle moves like this only. Once it reaches second to third year, it is in the EBITDA of 14 to 16%. And as we have opened a lot of stores this year, so it is going to give healthy EBITDA in the coming quarters from the next financial year.
Okay. Thanks a lot. Thanks a lot for your answer.
Thank you. Next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Yeah, sir. Thank you for the opportunity again.
Mr. Palash, your voice is not audible.
Hope I'm audible now.
Yes, sir. Please proceed.
Yeah. So, sir, again, on the comparison with the peer, one of the peer, they have alluded to lower markups, which has led to very high throughputs and footfalls for them. So, have you also experimented with that kind of strategy or any insights that you could share on that?
So I think whatever I have read the results of all the peers as of now for the 9 months, it has not been a very high gross margin impact on the numbers. It's only a % difference between all of us together in the delivered margin section. Yeah, in terms of, I will not say that we have done anything what our peers are doing, because as I told Naki, all the guidance that we are saying in terms of revenue growth that we want to achieve, we are able to achieve that. Yeah, as we are entering into a new territory in the focus states or not, so we are going with some aggressive pricing, that is keeping low pricing articles in the stores, which is helping us to build higher footfall and higher number of bills, as I said right now only. So that is the strategy that we are applying. So to attract a lot of customers in the focus states, we are keeping a lot of inventory at a entry price point levels, just to make them come to our stores, see our stores, feel our store, and maybe in the repetition sales, as I said, our repetition customer sales have been 72%. It has been consistent for maybe more than a year now. So we just create that room for by investing in more on the entry price point, so that we can bring more footfall of customers to our stores.
Yes, sir. Thank you for that. And sir, out of 45 to 50 stores or 100 stores that you would be adding in next 2 years, how many of those you expect to add in UP or Bihar, UP and Bihar combined?
Not particularly UP where, but as a strategy for the coming, at least for the next 1 year, what we see, 70% of the stores are going to open in the core states. For us, core states is a combination of Bihar, Bengal, Assam and Odisha, and 30% will be in the rest of the other states, which includes UP, Jharkhand, and other states.
Okay, sir. Thank you. Thank you for your answers, and that's it from my side, and all the best for the future.
Thank you.
Thank you. Next question is from the line of Shreyansh J from Swan Investments. Please go ahead.
Hello.
Yeah, hello.
Yeah, sir, my first question is, sir, could you explain to us your cost structure on a store basis, store level? So if I have to understand, when I'm just trying to understand your employee cost and your OpEx per square feet, so Q2, Q3 of last year, we were at 50 rupees and 55 for employee cost, whereas my understanding is that, sir, employee cost for a retail store is anywhere between 60 to 75 rupees a square feet. So, how are we so low, sir, versus the industry? And if I do a similar comparison for the other OpEx bit, we are at about $100 versus industry at about 120, 130. So, how are we so low versus the industry, sir?
So, coming to rental, because we are majorly in tier 2, tier 3 and tier 4 cities, so where the rentals are low. So hence in comparison with the competitors, it seems to be on the lower side. But taking rental and other costs together, the average per square feet cost is 150 around so at store level, and at company level it is around 190 per square feet, which is at par with the peers also.
And particularly the value peers.
Rent per square feet, sir?
It's approximately 50 to 55.
For the quarter and for the 9 months, it is around 48, yeah.
No, sir. So average, sir, on an industry, everybody is at 50 to 55, sir.
Yeah, so ours is 48. So 7 rupees, ours average is 48. As he rightly said that our cost per square feet is around 190, which is almost similar with the peers only. So it's not at a lower level.
No, but last year this was at about 150 and now we are at 190. So what was driving this 150 last year, sir?
So the rental last year was around 44 to 46 per square feet, which has increased to 50 to 55 because in tier 1 and metro we have opened around 30% of our stores, and due to that our rental per square feet has increased. And secondly, we have invested in manpower, and that has also led to the increase in the cost per square feet in employee cost.
So what should be your steady state employee cost and your rental per square foot, sir? Or if I have to understand your whole OpEx?
So if I say at the store level, if you see only from the store level perspective, for the first 9 months, it is around 122 per square feet for the last year, and it is the 3 costs that we have taken: employee, rental, power and fuel. And with the inflation and everything going in, it increased to 133 rupees per square feet. So there has been 11 rupees increase in 9 months on this 3 cost. And I think the only thing that increases in the employee side at the store level is the any change by the government on the minimum wages, which we increase in the store level. So that is the increase, which is typically around 8 to 9% on the employee side. So that is the growth typically around employee cost. And on the rental side, it's a 5% escalation every year. And again, power and fuel, depending on the agency or the company, it's around 6 to 7% inflation every year that we have seen.
Okay. And sir, you mentioned that we spent about 20 odd crores additional on some corporate overheads. So can you explain that, sir? Sorry, I missed that point. So what is that line item and where have we spent that, sir?
So basically, considering the future growth aspect, we have doubled our capacity of warehouse. We have increased the office space, and we have increased a huge number of manpowers at the back-end operation, procurement, technology level, and supply chain. So these 3 are the cost elements majorly on the account of which it has increased. If I tell you in terms of absolute value, so employee cost has increased by around 8 crores this year, our rental has increased around 3 crores. So 11 crore out of 20 crore is because of employee and rental, majorly, for this 9 months.
Okay. And, sir, so, what should we assume as the steady state OpEx now? The 60 crores of OpEx should continue for us going forward, or do you think we can go back to the 40-45 crores that we used to do last year? We can see that next year?
So I see, when you grow, typically last year we did I will say that the back-end expenses of the corporate overhead should be seen as the percentage of sale. So last year it was around 5.1. Because this year we have invested a lot of things at the recurring level. So this year it has increased from 5.1 to around 6%. And in coming quarters, again, because we have taken a lot of people this year around, and with the larger growth trajectory that we are seeing ahead, and the stores that we are opening, we expect this cost again to get reduced back to the same level of 5.1%, maybe in coming 6 quarters.
Okay. And so this last question, you said we spent something on technology as well. Now, sir, how do you expect these spends to, I mean, where should we see the improvement? Should it come on the OpEx bit? Should it come on the inventory turn side, or should it come on the gross margin? So what I'm just trying to understand, when you're spending this kind of money on technology, where should this benefit be visible, sir, on your balance sheet P&L?
So I will say, when we are investing, it will be more on the capital side, but in terms of efficiency, as you rightly said, it will be largely on the inventory side. So whatever we invest, for example, I'm just giving an example that we are investing on warehousing, which will help us to reduce the lead time to the store, which in turn will help us to have a higher sales throughput in the stores. So the higher will be the churning, higher will be the margin earned. Again, on the inventory side, we are doing a lot of things on the inventory side, in which, as you see right now also, we have reduced our inventory by 200 rupees square feet, whereas our sale per square feet has increased by almost 800 rupees from last year. So from last year, from 8,000, we have reached 1,800 while reducing the inventory by 200 square feet. So we are trying to reduce the tail of inventory, I will say that way. So there will be higher efficiency in the form of gross margin, higher efficiency in terms of increasing sale per square feet, which again will lead to majorly will be coming from the L2L growth also, that you can see, which in turn will give you a higher profitability. Apart from that, if you go for the ERPs and solution that we are planning to do, it will create a greater, I will say, discipline around all the functions. It will create a lot of processes, which will again help in improving the efficiency, because there will be a lot of SOPs and process to be followed, which I generally think is missing in a lot of retail companies, which we would like to improvise on.
Okay. All right, sir. Thank you and all the best.
Thank you so much.
Thank you. Next question is from the line of Ayush Sabu from Choice Equity Broking Private Limited. Please go ahead.
Could you please just give a guidance regarding the total CapEx that you will incur for the next FY25 and 26? Considering what the guidance you already gave for the technological developments, what would be a total CapEx figure that we could work with?
I think typically we will be opening, as we said, we'll be opening anything between 40 to 50 stores. And on an average, 1 crore to 1.25 crore is a spend on the store, depending on the location that the store gets opened around. So 40 to 50 stores will be the strategy for opening. And as I said, the capex will be, as I said, use the capex amount also. So you can expect anything between 60 to 65 crores on that side. And apart from that, if there's any other capex expansion going in the warehouse or the infra side, that will be the additional cost on that.
So additional will be around 15 to 20 crores, like you mentioned, right?
Yeah.
Okay. Thank you.
Thank you. Next question is from the line of Tanish Tolani, who is an individual investor. Please go ahead.
Hi, am I audible?
Yes, please go ahead.
Thanks for taking my question. My first question is regarding guidance for ROE. Hello.
So ROE, it will be around, last year it will be floating, with respect to last year itself, it will be 10% to 11% only.
And what's the, matlab, and how many stores in Q4?
So as I said, that for the entire year, we'll be opening anything between 40 to 50 stores. 43 stores have been opened, so maybe 7 to 10 stores.
Okay. And e-commerce side, are you looking for e-commerce?
So see, in terms of e-commerce, our strategy is very pretty clear. We are working on two models. One is on the Omni side. What we have created is that in terms of Omni, at the store, anyone goes for shopping, he can, and if he doesn't find any size or color, that can get delivered to his home. We have started it last year, and we are seeing a good traction of revenue coming from that on the Omni side at the store level. On the e-com side, we are still in a stage where we are planning to create an ecosystem, but it will be largely around our own website, because what we have seen is that even though if you are going to quick commerce or to the e-com, on the marketplaces, the commission cost is very high, and with the margins that we have, it will not be a profitable model for us, and we want to build a profitable, sustainable model. So e-com will be there, but it will be largely around our own website, to which we are going to, it will be just like a convenience for the customer, whether they can buy from stores, or maybe they can buy on the Omni channel, and or maybe they can buy on the e-com. But e-com will not be the focus area.
Okay.
Mr. Tanesh, does that answer your questions?
Yes.
Thank you. Next question is from the line of Arman from Blue Sky Capital. Please proceed.
Yeah, thanks again. Just I want to have a general understanding, because from October to 10th January, I guess, we closed 3 stores, one in Jharkhand, one in AP, and one in Chhattisgarh. So what's the strategy company follows in deciding where to open any store, and what dynamics do you see? Also, if our focus area still be on the core areas like West Bengal, where we'll open more, so will that mean that our renting costs will increase, because already we have established so many stores over there, and new area finding would not be that much lucrative as it has been in past? Thanks.
No, I don't think so that way. In terms of closing the stores, a simple strategy that we follow is that while we're selecting a store, we have a lot of processes that we follow. From business side, going over there, creating a scorecard approach in which they see how the catchment is, how many universities, and what is the size of the population of the catchment over there, a lot of things, and then they create a business plan. Generally, stores are 95% stores are getting closed because of the wrong estimation of revenue, and I think which will be the case when we are opening stores. But for us, if you see, from inception till 31st December 2024, we have shut down around 27 stores, and we opened around 200 stores. So typically it has been 11% closure rate for last 11 years, so which is pretty good. There will be some hits and there will be some misses, but again, the reason behind such a good rate again is the cluster-based approach that we have followed, and which help us to know which are the pin codes where we can open stores. We know our catchment better, we know our product assortment better. As a result, the closures are lesser. In terms of future expansion, why we are creating this focus states? Because once you reach the maturity at the core state, you require some future stores to develop. Generally, between 5 to 6 years, when you spend into a territory, you lesser than 4 to 6 years, you tend to understand that territory very well, and that territory converts from focus to core. So going forward, as I said, UP will be the target states where we will be opening more stores in the focus area, and along with that, the core, because in core we have such a good expertise. So I think still there's a lot of area where we haven't opened the store. So till the time we reach that maturity level, we will be opening the stores over there also.
Okay. And my last question is, like, what is our marketing strategy over there? Like, just for example, big players, like I could see on YouTube many of their videos Or what's our specific strategy? Because we are regional specific, definitely we would have some regional specific strategies. But what's the strategy companies follows to increase the look and feel and awareness for the company in the stores? Is it the organically driven, just word of mouth, or company spends? What kind of strategy does company follows?
So company spends according to the area. For example, right now we are focusing more on UP, and I've told in last call also, but if you go to YouTube and if you just type Kesari Lal Style Bazaar song, so we just launched that song in the month of Diwali Chhat, and that song has got more than 34 lakhs views as of now. And that song is about Style Bazaar collaborating with Kesari Lal as a celebrity. And in the song, the entire the script they are showing Style Bazaar stores. They are showing the products of the Style Bazaar. So we try to work more on the regional celebrity side, more on influencer activities, which help us to connect with the local people. Because larger 90% of the audience whom we want to target are more of those people who are following the local celebrities. So this kind of advertisement is done by us in every state. In terms of total spending, we generally spend around 1.5 to 1.7% as a total spend at the company level, which again changes between state to state.
Okay. Thanks a lot.
Thank you. Next question is from the line of Ayush Sabu from Choice Equity Broking Private Limited. Please go ahead.
What will be the trend of, the debtor and creditors days as we go ahead and as we increase the store expansion? Would you see it improving? Or would you see the creditor days coming down or below the 70-75 level, or would it just stay there?
So at present, it is 72 days vis-a-vis 83 days last year. So it is on the declining trend, and we hope to maintain between 60 to 75 days in coming years also.
Okay. Thanks.
Thank you. Next question is from the line of Kushal Goenka, an individual investor. Please proceed.
Yeah, hi. Thank you, sir. So my first question was, when can we expect the fire insurance money to come in?
We are expecting that to be closed by this March end. The figure will be closed by this March end, and interim relief or full payment will be released within this period only.
Okay. Thank you, sir. And my second question was, since January is about to end, can you tell what is the trend for Q4? How is it panning out compared to last year, Q4?
See, I cannot comment on the Q4, but yeah, as I already said that we are expecting a good momentum that has started in January itself, and we expect a good numbers with the Eid coming in March.
Okay. Thank you, sir. And sir, last question, sir. Sir, any new state are you looking for in the focus state? As you said, you are looking to expand more in UP, but any new state where you are not currently present, are you looking for that in Q4 or next year, FY26?
As of now, no, we are not looking at any other states because I think there is a lot of potential. And as a strategy, as I said, we have the strategy to go in a cluster. So we go deeper into any state where we open stores. So the strategy will remain same. And UP, Jharkhand, Bihar, Bengal, Assam, Odisha will be the states where we will be opening more and more states going forward also.
Okay. Sir, but as I can see, I guess in Tripura you have 2 stores, Arunachal 1 store, and Andhra also you have 5 stores. So are you planning to expand in these states more?
So in terms of Tripura is a very small state. I think maybe 1 or 2 stores can be added more over there as of now. So as a strategy, we are not going on in that particular state. Again, Arunachal Pradesh was just an extension to the Assam, because it is near to Assam and we got a very good location, so we opened, and the taste and preference is also similar to Assam, so we took a decision over there. Andhra Pradesh is again an extension to Odisha, so it's not a state specific call that we have taken because of some cities falls into that territory, so that's why the state changes. It's basically a border area of Odisha where we have opened stores which falls under Andhra Pradesh. So as a strategy, it's only Odisha.
Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Shreyansh Surana for the closing comments.
So thank you, guys. Thank you for attending this call, and we hope to give good numbers in the next coming quarters. Thank you so much.
Thank you. On behalf of Baazar Style Retail Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.